Okay, this video covers the revenue recognition complication of long-term contracts. So check out this picture. Whoa, that is an F-35 jet, and Lockheed Martin designs, builds, and delivers those jets to customers like the US government. And it takes a long time to do it. They don't just do it in a day. So the question here is, can Lockheed Martin recognize revenue as they are designing and building the jet? Or do they need to wait until the jet's delivered to the US government to recognize revenue? The answer is they can recognize revenue along the way as they build the jet. And they use a percentage of completion method called the cost to cost method. And the cost to cost method says that the company in a long-term contract can recognize revenue in proportion to the costs that they're incurring. And the best way to learn this method is to go through an example. So let's go through an example. Here's what the example will go through. Lockheed Martin agrees to build an F-35 for the US government. The price tag on the jet is going to be $100 million, and the total expected costs are $80 million. So when they sign this agreement, they expect to spend $80 million to construct and deliver the jet. Okay, so those are the details. What is the expected profit of this contract? Well, they're expecting to profit $20 million, 100 minus 80. So $20 million on a $100 million price tag, that's a 20% profit margin. That's what they're expecting. I just want to build that in at the beginning. So let's go through what Lockheed Martin would do after 1 year goes by, how they would use this cost to cost method. So after a year, let's go through two events separately. A, let's say the US government has fully paid the entire $100 million price tag. And B, Lockheed Martin has incurred $40 million of the total costs. So let's go through both of these events, and let me move myself out of the way now because now I'm in the way. So I'll go up in the corner, make myself smaller. Okay, here I am in the corner, and let's go through it. Part A, the US government pays the entire $100 million price tag. Well, Lockheed Martin's receiving $100 million in cash, so debit cash, but they haven't earned it yet, at least for Part A's purposes. So they're going to stick it in a deferred revenue account, a liability account. Lockheed Martin has an obligation, has a $100 million obligation to produce and deliver a jet. That's what that is. So that's Part A. Now let's talk about Part B, because Part B is the cost to cost method. Lockheed Martin has incurred $40 million in total costs so far. Now they're still expected to spend $80 million of cost, let's assume. So how far through this project are they? So first of all, let's recognize those costs on your income statement. So debit cost of goods sold for 40 million, because we've incurred 40 million of cost. And let's just assume we as Lockheed Martin paid cash for those costs. So credit cash for 40 million. Okay, now let's implement the cost to cost method. We've incurred $40 million of an expected $80 million total cost. 40 over 80 is the same as a half. We've incurred half of our total expected costs. So let's recognize half of our total expected revenue. Total expected revenue is 100, so 1/2 times 100 is 50 million. So we'll recognize $50 million of total revenue. So we'll move $50 million out of deferred revenue and into revenue on the income statement. $50 million credit. Okay, so let's just think about what the income statement would look like now. The income statement after 1 year has gone by would have revenue at the top of 50 million and cost of goods sold of 40 million below it, for a net income for this one transaction of $10 million. Well, $10 million over $50 million of revenue is that same 20% profit margin that they're expecting to have over the entire term of the contract. So this method maintains that profit margin over the term of the contract, which is one nice aspect of this method. Okay, so that's how Lockheed Martin implements the cost to cost method. It's a percentage of completion method for long-term revenue contracts. And finally, what I want to show you, just an extra little piece here, is I just want to show you their financial statements to see how these transactions show up in their financial statements. So we're going to go to the internet. Let's go to the internet. So here's the internet. This is what it looks like. And my homepage is Bing, of course, because they've got cool pictures. Not because it's a good search engine, but because they've got cool pictures. That's what the good thing about Bing. So we'll go to sec.gov to get to the SEC's website. And mine's a little zoomed in, so it might look different from when you just go there on your home computer. But I have to click these three bars over here and go to Filings. Then I'll go to Search for Company Filings. And I'll search by company or fund name. And the company name we're interested in is Lockheed Martin. And so here's Lockheed Martin filings list. There's Form 4s. That's when an insider buys or sells Lockheed Martin stock. 10Q, that's a quarterly financial statements. 8K, that is a material unscheduled event that investors should know about, and so on. So here's all their filings. They're in order of the date that the company filed it. And the filings we're interested in are 10Ks. So let's search for 10K. And here's a list of their 10Ks in order. And we're interested in the most recent 10K. So this 10K was filed February 7th, 2020. And we'll click on the documents link. And here's a listing of all the documents and exhibits and things. But the one we're interested in is this top line, which is the 10K. So we'll click on the 10K. Okay, so here we are. We've made it to the Form 10K for the fiscal year ended December 31st, 2019. And this is for Lockheed Martin Corporation. So good, we're in the right spot. And what we're interested in is the financial statements. So how do we find that? Well, one of the easier ways to do that is to go to the table of contents here. And we'll go down to item number 8. Item number 8 is financial statements and supplementary data. So, okay, let's click on that link. And the first thing you'll normally find in item 8 is the auditor's opinion. So this is an independent third party giving you the opinion that the financial statements are fair to look at. Like it's worthwhile to look at them because they're fairly presented. That's the audit opinion. We're going to scroll past that. And in fact, we're going to scroll past the financial statements at first here. So finally, we get to the financial statements, consolidated statement of earnings. That's the income statement. We'll scroll past the statement of comprehensive income. More on that later in the semester. We'll scroll past the balance sheet, the statement of cash flows, the statement of stockholders' equity, and we'll get to the footnotes finally. So here we're at the footnotes, and we're interested in actually in typically what is footnote number 1 is the significant accounting policies of the company. And the accounting policy we're interested in today is the revenue recognition accounting policy. And okay, no thanks on that pop-up. So the revenue recognition accounting policy is actually pretty long for Lockheed Martin, and I only want to read you a specific part of it. So let me go down to that part. This part here. So I'm starting here. It says, for performance obligations to deliver products with continuous transfer of control to the customer, revenue is recognized based on the extent of progress towards completion of the performance obligation, generally using the percentage of completion cost to cost measure of progress for our contracts because it best depicts the transfer of control to the customer as we incur costs on our contracts. So there you go. There's how you find out what accounting method Lockheed Martin is using to recognize revenue on these long-term revenue contracts. And the final thing I wanted to show you is a piece of their balance sheet. So let's actually go back up to their balance sheet, and I'll show you a couple of the accounts that are related to this method. So we'll start in the liabilities section. And remember when we credited the deferred revenue account when the government paid Lockheed $100 million, and then we debited the deferred revenue account to move it into revenue when they finally earn the revenue. Well, what does Lockheed Martin call that account? They call the account contract liabilities. So that's what they call deferred revenue. And that is, as of December 31st, 2019 there, the balance in that account is $7 billion because this balance sheet is in millions. So contract liabilities of $7 billion means that Lockheed Martin received $7 billion from the customer. And as they incur costs on those contracts, they'll recognize that as revenue in proportion to the cost that they're incurring. So that's what that contract liability account is. They also have another account for a different scenario, and that's up in the asset section. So in the asset section, there's an asset called contract assets, and that one's $9 billion. So that's the opposite scenario in terms of they haven't received the cash yet. So instead of receiving a prepayment like they did in our example, this would be if so Lockheed Martin signs into a long-term revenue contract and they start incurring costs on that contract, but they haven't been paid any money yet. So they've incurred costs and they have recognized revenue under the same method. It's just that when they credit the revenue account, the account that they're debiting is this contract asset account because they now have a receivable. So that contract asset is similar to a receivable in that the customer now owes them some money under that contract. So that's another account related to the same cost-to-cost method. And if you're just an investor and you don't have this video to learn from, how would we find out more about these accounts? Well, you can just search for them in the footnotes. So I will Control F and hope maybe I'm in the way of this Control F now. So I'll move down a little bit and I'll Control F for contract assets. And I'll keep hitting enter until I come, and here it is in bold. So here's the company explaining what are contract assets. They include unbilled amounts typically resulting from sales under contracts when the percentage of completion cost-to-cost method of revenue recognition is utilized. And revenue recognized, so the amount of revenue we recognized on the income statement, exceeds the amount that we've billed to customers. So they still have to bill those revenues to customers. And if you're interested in the contract liability account, it's right down here. Contract liabilities, they formerly called it customer advances and amounts in excess of costs incurred. So that was kind of a mouthful of the name of an account. So they changed it to contract liabilities. And these are advance payments and billings in excess of the revenue recognized. So there you go. Those are just a little bit more information about those accounts. You can always find more information about the material and significant accounts on a financial statements by looking down in the footnotes. Okay, so that's enough of that. That was just going over a long-term contract complication to revenue recognition. And specifically, we looked at Lockheed Martin and how they use a percentage of completion method called the cost-to-cost method.